Hey everybody, this is Faris Sleem, the editor of the Bowser Report, the monthly penny stock newsletter. Today I wanted to make a video real quick going over a question that we get a good bit on the forums on our website and just in general from penny stock investors, and that would be stop orders. Okay, so stop orders are used both to capture reward, right, take your profits, and also to manage risk. They're commonly referred to, and really the connotation they have is just to manage risk in general for your positions. But seeing as we recommend numerous penny stocks and we have multiple positions on the table long term, this is something that could be really handy in just automating your portfolio and making sure that you're getting the exact price that you want for your buys and your sells. Okay, so the two platforms that I have up here in the background are the E-Trade Pro platform as well as the TD Thinkorswim platform. It doesn't really matter what brokerage you have. For the most part, a lot of the orders are at the very least very similar. So, stop orders and when they expire and whatnot can differ based off of different brokerages, but especially for the bigger brokerage firms, they are usually the same, okay, if not very similar. So we're going to talk about the orders on the E-Trade platform, but we're going to use the TD platform just to show you prices and what exactly these orders would translate to. Okay, so here we have the basic order entry screen for E-Trade Pro, and it's fairly simple, right? You have the ticker, you have the number of shares that you want, and then you can have the actual order type that you want. Okay, now first things first, right? The ticker that we're going to refer to is ReproMed Systems, REPR. This is a stock that we recommended way back in 2010. And again, if you're unfamiliar with the Bowser Report, right, we're a long-term penny stock picking newsletter. Okay, so this is a play that's been in our portfolios for almost 9 years now, and we initially recommended it at 16 cents. So you can see how it's climbed, but we're going to kind of take the approach of somebody who's new to the Bowser Report and somebody who was also new to penny stock investing, and how you would manage risk moving forward and take profits moving forward based off of just a standard entry, right? Let's say you relate to the party. So we're going to kind of put it into that context. Okay. Now, again, we have the various order types here, but I want to clarify the Bowser game plan, right? And how exactly we take profits and manage our risk, right? So first things first, we sell half of the position when the stock doubles. Okay. And if you don't know the full Bowser game plan, this is just a small piece of it, right? But it's pretty much our guideline for investing. If you don't know the full game plan, I'll link it on this video. We have a very extensive YouTube video on our channel as well. But we sell half of our position when it doubles, okay? And then after that point, we trail a stop loss, meaning that if the stock pulls back 25% from that point, then that will close out the position on the second half. All right, so therefore you're kind of managing risk, but also making sure that you're taking your profits on the trade, okay? Now, the other side of this, because you can't assume every single investment is going to be a winner, is that we cut our losers at 50%. Now, to some of you guys, that might seem a little bit extreme. Okay, and that's the full size, right? We cut it at 50%. It's not half and half. It might seem a little bit extreme, but keep in mind we're using very small sizes with very small stocks, right? We don't pay over $3 for a stock that we recommend. Okay, so a 50% loss on a $500 position really isn't that substantial out of your $10,000 to $15,000 portfolio, right? You don't need that much, but just as an example, right, it's really not that big of a hit. So again, you can't assume every trade is going to be a win. You can't assume every trade is going to be a loser either. So you have to have a game plan on both ends here for profit and for loss. Okay. Now, to go over these order types and just kind of simplify this, I'm going to regularly be referring to these as limit or market orders. They're fairly simple concepts. If you don't know what they are, I'll briefly explain them, but I would recommend looking into it because that really changes your perspective in terms of how you're placing these orders, right? In my opinion, and again, this is all based off of experience, you might think something differently, and that's perfectly fine. I prefer limit orders as opposed to market orders, okay? The difference is really the speed and the price that you get. So market orders are guaranteed to fill, and they usually fill immediately, depending on how quick your brokerage is. Any big name brokerage house is really going to fill them right away. But they fill immediately, and you get whatever price is being bid, right? And that's not necessarily guaranteed either. So let's say that REPR, ReproMed Systems, is trading with a bid price of 3.10 and an ask price of 3.15. Okay, a market order, best case scenario, is probably going to fill you at around 3.10. All right, again, this is the bid. This is what they're asking for. So buyers are sitting there, sellers are sitting here. Okay, a limit order does not guarantee your fill. It might not get filled at all, or even just a partial. And you do get to specify what price you want. So let's say that, you know, for the size that I have, let's say I have 1,000 shares of this, right? And I don't really want to settle for 310. I want to sell at 315. So if I put in a limit order at 315, that means I'm not going to sell at any price lower than 315 when I'm exiting my position. Okay, so again, market order, very quick, guaranteed to fill, but you're not going to get the optimal price. That's the gist. Now, the kind of tricky part about this, and again, if you don't understand these two concepts, that's fine, right? Everybody starts somewhere. You just go look it up, do a little bit of research on it. But the tricky part about this is that we have stop limit and stop market orders, and we have trailing stop limit. And well, really, I'll get to that in a second. Let's get into the stop limit and stop market orders. Okay, so you can kind of scroll down this list and see. And again, every brokerage has a very similar list. Sometimes they're worded a little bit differently, but if I wanted to buy or sell, right, I could put either a limit or market, and I could specify my price. Okay, right? And we're not going to talk about market on close, but if I want to place a stop order, all right, notice how it has two options right off the bat. Stop on quote. Okay. And then we have stop limit on quote. So a stop order allows you to really not have to sit to by your computer all day or look at your phone all day, whatever you're placing your trades on, and make sure that you're getting the same price. So as long-term investors, right, this is something that is very useful to us, especially if, you know, you're going on vacation or if you're not going to be in the office, whatever it may be, right? So a stop order allows you to take profits when a certain price is hit. All right. So let's say I own that 1,000 shares that we were talking about of ReproMed. Let's say I got it at $1, right? You were not a subscriber back in 2010. You know, you're somewhat new to it. Let's say you got it at $1. Okay. And again, you have 1,000 shares, hypothetically, right? So a stop on quote allows you to take profits at a certain price. Okay. So if I put on a stop on quote order, I can specify the price here. Let's say that I want to sell at a double, which is the Bowser game plan, right? So I'd put 2.00, all right? And then I would put sell because I currently, hypothetically, have a position in this stock, all right? So I would hit sell, and that order would be good until the end of the day. Now, here's the catch, and this is where it gets a little bit tricky. You can use a GTC, a good till cancel order, which allows it about 30 to 60 days before it expires. So one thing I will say, and we'll get a little bit more into stops after this, GTC is a very common way of making sure that your order doesn't expire. And it's exactly what it sounds like, right? It's good until you actually cancel the order, right? So it's not going to expire at the end of the day, which can be kind of annoying if you're trying to get a price that you want, whether that's on the buy or the sell side. But it will expire depending on your brokerage, usually between 30 to 60 days. Okay, so I'm going to put this as a GTC order because that's obviously more favorable, and I would hit sell. Now, again, this gives me 30 to 60 days to do whatever I want, right? I can go run outside, I can go crazy, I can do whatever. I don't have to sit by my computer and see if I'm going to get filled at $2. And if the price, let's say, spikes up to $2 one day, right? Let's say it's not a gradual increase, it spikes up to it, and it hits it, right? Then it would sell my shares and it would be done for, right? It would be done. That's it. Okay. Now, again, stop on quote is specifying a certain price, but the difference between these two is actually fairly simple, right? You can see that there's one word that sticks out here because it's stop on quote, stop limit on quote. That's the only difference right there, is that in this case, right, the difference between both of these is that this is a limit order and this is a market order. So let's say that ReproMed system spiked up to do $2 per share, right? And we can kind of look in the background here. And let's say that this move to $2 was a spike. It wasn't a gradual gain like it looks like on this chart. And it spikes up and then it drops back down. So for penny stocks, a lot of times there isn't a lot of volume. There isn't a whole lot of liquidity, so they can be pretty volatile. So it spikes up to 2 and then it drops down. And I had a stop on quote, not a stop limit on quote, right? So what that's going to do is that, let's say the asking price is $2, okay? And the bid is at 190. All right, that's a pretty big spread right there. That's a 5% bid to ask spread. It's the difference between those two numbers. In that case, right, I would get filled at 190 best case scenario, because chances are buyers aren't going to overpay for shares here. It's just kind of a little hiccup in how this stock is moving, right, in general. So you're not going to get the best possible exit. But if you do a stop limit on quote, you're sacrificing the speed. You're sacrificing the idea that you're not guaranteed to get filled, okay? But you are getting the price that you want. So in that case, you would have gotten filled at 2 for the limit. Whereas the stop on quote, best case scenario, you probably would have gotten filled at about 190, depending on how much volume was flowing through that stock. And I know, again, that this is just based off of my opinion that the limit would be better in this scenario, but a lot of times it really depends on the stock. If the stock has consistently high volume, right, then you should definitely use stop limit orders. If it doesn't, you might want to use the market. And I know you wouldn't get the best price, right, for the market order, but to me, it's more important to get out, right, when there's a lot of volatility and it's trading on low volume than it is to get the price that you want. So it's really just deciding between those two, right, whether or not you want to get filled completely and you want that order to go through, or if you want a specific price. Okay, but if the stock has consistent volume, use the limit. All right, that's definitely the more favorable of the two. Okay, now trailing stops are much more common. They're a lot easier to use in my opinion, because even though, you know, with a stop on quote, right, we were talking about a hypothetical scenario where you own 1,000 shares from $1. Okay, let's say you take half your profits, so you sell 500 shares at $2. You still have 500 shares remaining with a cost basis, right, at $1. Okay, now in this case, what we do is we throw on a trailing stop. Okay, trailing is exactly what it sounds like. Where a stop by itself, right, just the word stop means that it's above the price that you got in at. A trailing stop is below, right? It's trailing, it's following you below. So even though a stop can be used to the downside, right, trailing stops are better to use to the downside in my opinion, because they just immediately protect your profits, and you kind of get to keep that percentage drop that you want to max out at. And let me specify what I mean there, right? Again, we went up to $2 per share. So if I want to put a trailing stop order at 25%, meaning if this stock pulls back 25%, right, it'll sell the remainder of my shares. It's kind of protecting your position, okay? The idea there is that you would get filled. It would be very simple, but it would be a huge hassle that every single time, you know, the stock closed at a slightly higher price, you would have to update your order, right? So that's where the trailing stop comes in. You're able to say, okay, let me define a percentage, and in this case, it's 25% that I want to trail a stop at, and that's that. So if it pulls back, it'll hit it, okay? So if we look at this chart, hypothetically, right, we have 500 shares left at $1, and it just hit 2. So right now what we're doing is we're just putting on a trailing stop order for 25%, okay? Meaning if it drops in this case scenario, right, to $1.50 per share, right, so that's down here, all right, then in that case, you would sell, right? The order would go through and it would fill. And what that does is as the stock moves up, this order just trails behind it. So I'll put it in red. This order is just going to trail behind it. And if the stock gets a more aggressive pullback, in this case, it didn't, right? ReproMed Systems really hasn't pulled back substantially off the highs. But if it were to, right, if there was bad news, bad earnings, maybe a market correction, whatever, then we would be prepared, and that would be protecting the profits. Again, it's really easy hindsight to look at this and say, well, ReproMed systems never dropped, so who cares, right? That didn't actually play into this. But you can't assume every stock's going to be the same. And, right, if you trade without a game plan, if you're investing without a game plan, then you might as well just not invest at all, because there's no system behind what you're doing. Okay, there's nothing proprietary there. So in this case, you can see we just have these little red lines trailing as a 25% stop loss. What this would look like when you're entering it is a trailing stop percentage, and then we just put 25. Okay, the value again is in percentage here, so we just put 25, and then I would put sell. All right, obviously with the correct number of shares here because we switched up our position, but we would hit sell, and that would confirm it, and that would keep going and cover our potential losses. Okay, now if I wanted to do it based off of a specific dollar amount, right, I could just do trailing stop dollar. The only reason I would recommend a percentage over this, it's easier based off of our game plan, right, instead of having to calculate it out. And usually, right, if you're trailing a stop, it's because the stock is going up, right? It's because you're trying to protect your capital gains. Okay, so if I'm trailing a stop on ReproMed systems, right, you can see that from $2 per share, that's where we started putting the trailing stop on. All right, at $2 per share, we do 25% of that. That's 50 cents, okay? But let's say the stock goes up to $3. Your 50-cent trailing stop isn't really as relevant because that's not 25% of $3, okay? So I really prefer the trailing stop percentage. It's all up to preference, but what that looks like is if we were just going to trade this with a 50-cent trailing stop is this, right? We would have $2 from here, and as it moves up, this would just be 50 cents below every time. All the way up. So if the stock drops past any one of these prices, let's say it downturned, that would hit your sell, and you would exit with a nice gain. Okay, so just to review real quick, and again, remember, you can always pause this video, rewind it back, watch it again, slow it down if you need to, or comment on the video below if you have any questions. But just to review, right, we talked about the basic game plan we have, selling half at 100%, then the second half at 25% below that, okay, if it were to pull back. All right, so you would just trail the percentage stop, and this would be a limit stop or stop limit, whatever you want to call it. Okay. Now, the other side of it, just in terms of protecting the position in general, we would do full size sell, not a half sell. Half sell is only for the profit taking. Full size sell, so you would exit the entire position if it were to drop 50%. Okay. In that case, trail a stop percentage, or just put that stop order itself at the specific price. So either a stop limit or a trail stop percentage. Again, more than likely you're going to use the stop limit, but it's just based off of personal preference. In my opinion, if the stock has enough volume, you should just use limit orders for these, right? Stop limit and the trailing stop percentage. But again, it's based off of personal preference. All right. And this is what it looks like on the actual order screen. I wanted to make an effort to do this because it's really easy just to say things in a video would not actually give you a visual. I think actually going through and putting in this order, even if you're just paper trading in a platform, goes a very long way. That's where you get the best experience. All right. So limit and market, we talked about the difference. Stop on quote, stop limit on quote. All right, for protecting your position and also taking profits. And trailing stop orders are very, very useful. Just make sure if you are putting them in, right, that you're updating them regularly every 30 to 60 days, and you're using a GTC order, good until canceled. Okay. But again, as mentioned, if you guys have any questions, feel free to leave them in the comment section below. If you did like this video, we have plenty of other videos on our YouTube channel and a lot of free content on the blog of the actual Bowser Report website. That's thebowserreport.com that you can take advantage of. And if you want to take your investing to the next step, we have a monthly paid newsletter, which is virtually nothing compared to how much many of our subscribers make. It's under $10 a month, and you get stock picks, in-depth analysis, 8 pages of notes, tables, articles that are useful to you, and that comes out the second Friday of every month. Okay, and that's just scratching the surface with what the subscription gets you. So hope you guys enjoyed the video. Thank you so much, and have a good one.